Hi, everyone. I'm Will Osborne.
And I am Ian Robertson, and we are excited to talk today about short-term rentals.
That's right. Yeah, let's get into it.
Let's do it.
So, we start this off the same way every time, but just want to make sure everyone's on the same page on what a self-directed IRA is. So, really, it's an IRA like you'd find anywhere else. That's how I like to think of it. The only difference is we at Madison Trust are able to hold alternative investments in the account, which includes real estate and especially short-term rentals, among other asset types. And we have plenty of webinars and resources on our website that go over really all the options. I mean, we've seen it all, but real estate is, I'd say, by far the most popular. Would you agree?
Absolutely.
Yeah,
Definitely.
exactly. So that's really the point of this, just to be able to diversify into different asset types. Normally people are pigeonholed into the standard Wall Street products, but don't realize they can really broaden their horizons with a self-directed IRA custodian like us.
Right. And just despite the name self-directed IRA may be found at places like Fidelity or Chase or other places, it's definitely different that you're choosing your own stocks. In those cases, you're really just unlocking all sorts of different options. So today we're talking specifically about short-term rentals. Obviously, like we said, a lot of our clients are invested in real estate, long-term rentals in a lot of cases, land and other real estate ventures. But today we're going to dive deep into short-term rentals. And so first, we're just going to define what that means in this context. Really, we're talking about short stay properties. Usually, vacation rentals would be another common term that you'd hear it through Airbnb, Booking.com, VRBO, any of those types of options. Properties where, to be clear, you're not staying in, somebody else is staying in for a short period of time. It could be extended in some cases. I know on Airbnb now you can stay like months
Yeah,
at a time, which is kind of cool. But this is those types of opportunities in rental properties.
exactly. Yeah, and they're becoming more and more popular. So there's strong demand. I know that I've stayed in many Airbnbs over the last 5 years or so. I've definitely, I mean, and we all know this, but I've definitely noticed myself that they're very popular. It's usually like when I'm with my friends, Airbnb is the first option instead of considering going to a hotel. So there's a lot of potential there. Vacationers, as you mentioned, just traveling for business, remote workers, get a change of scenery, and there is a strong income potential depending on where you live. So if you live near a beach or just any popular destination, having a property that is rented out short term could really be a significant source of income for your IRA. And relative to long-term rentals, if there's a high occupancy rate, there really could be again, a very, very strong income potential there. And on top of the stream of income, you're also getting the potential asset appreciation. So we have clients that, maybe their concern isn't generating income, but they're buying a property, whether it be raw land or an actual home that is going to more than likely appreciate in value. Obviously, nothing's guaranteed, but that is their goal. So a lot of potential here across the board for a really fruitful IRA.
Yeah, absolutely. And just a side note, a unique situation. I had a friend a few years ago now at this point that moved down to Texas, and he didn't have a place to stay immediately. He didn't have a home or anything ready to go for him. So what he did in the short term was stayed in an Airbnb.
Right.
And works out great. The longer you stay, sometimes the less you get some discounts and things. But yeah, he was able to stay there a couple months and then end up in a place long term. So there's a lot of unique things
Yeah.
with short term
Very
rentals for
cool.
sure. And so yeah, the things that we mentioned that are true about short term rentals are also pretty strong advantages for a self directed IRA, right? These are opportunities for you to take more control of your retirement funds and put them to work the way that you want to put them to work, not the ways that you may be limited to currently. And so while you're diversifying a portfolio, it usually goes beyond that. It's usually not just about diversification, but more so about generating either higher returns or more consistent returns. Some people they like to see a steady flow, more consistency in their returns. Other people want the opportunity for higher growth. Short-term rentals obviously can provide that type of return, and it's also about investing in opportunities that you know, that you understand. We have a lot of clients that are realtors and in the real estate space as investors already personally. And so these are people that understand the industry and are able to just learn about self-directed IRAs and connect the two, to be able to invest in things that you understand better than most people do. And that really just gives you the upper hand in this space.
It's really a no-brainer for individuals like that, in my opinion, at
Yeah.
least. So when it comes to the tax advantages, again, these are still IRAs, so all the same tax advantages apply. Traditional IRAs pre-tax. So you normally get a tax deduction up front, and in retirement, when you hit that age and you start taking distributions, anything that's taken out is taxed as ordinary income. So it just depends on your income for that particular year as to the implications. Roth is a bit different. So you're paying the taxes up front. So in other words, you're not getting a tax deduction, but in retirement, there's a few criteria to meet, but you can take tax-free distributions. Just need to be 59 and a half or older and have had a Roth for at least 5 years. If you meet those criteria, everything's tax-free. It's fantastic. And yeah, so when the asset is under the IRA and income is being generated, or if you sell the property, the proceeds go back to the IRA, none of that is taxable. The IRA is shielding you from immediate taxation. With the Roth, it's tax-free regardless, again, if you meet those criteria. But that's the whole point. So no need to worry about capital gains or taxes on the income that's being brought in on a whatever frequency. So that's the real purpose of this, shielding from taxation, and again, all the other benefits that Ian listed in the last slide.
Yep. And I want to pause here for a second and talk about the account types a little bit more, because this is a really common question that I get when people start going through the application process is, okay, your application asks, what type of account am I establishing? Am I establishing a traditional IRA or a Roth IRA? And they're not sure. In most cases here, especially if you're investing in a short-term rental, you have to have enough in a retirement account to bring over to begin with. And so wherever you're bringing it over from, you're matching the account type to that. So if you have a 401k, most of the time, those are pre-tax, and so they would roll into a self-directed traditional IRA here. Or if you have something called a rollover IRA, it's the same thing. It should be treated the same as a traditional IRA. So those would funnel into the self-directed traditional IRA, in this case, the tax-deferred option. Usually you would know if you have a Roth, either a 401k or a Roth IRA, and so you would set it up as that. But I just wanted to take that side note just to mention that, because that sometimes holds people up.
Yeah.
And to now touch on, in my opinion, the one of the biggest considerations here is what you can and cannot do with the property itself. So a lot of people that I talk to would like to use it as an investment property just to generate income and grow their retirement account, but they want to use it for a little bit of time. Maybe it's just a weekend here or there. Maybe it's a week in a year. You cannot do that with this. So that's one thing just out of the gate that you have to accept and be okay with. And if the property is in your town anyway, then that's probably not a shock to you, not a big deal there. But if it's in another area that maybe you love to vacation in, keep in mind you're not going to be able to utilize that property personally. The same goes for certain disqualified persons listed on the screen. So that's you, your spouse, parents, grandparents, children, grandchildren. Those are the relationships that would be disqualified from utilizing this property in any capacity. Same from doing any work on the property. And sort of a perspective shift that I try to help people have when they realize they can't stay there for any length of time whatsoever is think about how much income the property is going to generate, and then consider how much it would cost for you to stay in a nearby Airbnb for that week or for a couple weekends out of the year, whatever the case may be. The cost of having to stay in a different property should be far less than the income potential and the opportunity of generating income with one of these properties. So that's just a consideration, sort of a perspective shift to try and help get you in the right mindset. But those are the rules at a high level that that you should be considering with this.
Yeah. And just one thing, you mentioned not working on the property. Sweat equity would be off limits, as we know. So any physical labor, and the logic there is it's seen as an improper contribution to the IRA that's not made in cash, which is a requirement. So no sweat equity, no physical labor, but vetting tenants or setting up the account with Airbnb or Verbo, or hiring contractors. That's more administrative, so that's okay for you to take care of. But the line would be, is it physical labor? Is basically the idea here. So just thought I'd throw that in there. This is another very important consideration, in addition to the disqualified individuals, the tax implications that can potentially apply to short-term rentals under the IRA. So the tax is called UBIT, unrelated business income tax. So basically, UBIT is imposed on tax exempt entities, and an IRA is tax exempt, as we discussed. And it applies when, an IRA or, maybe a nonprofit is involved, or rather, it generates active income from a trade or business that is not substantially related to the purpose of in this case, IRA. The purpose of an IRA is to generate passive income for your retirement. It's not to run a business and generate active income. So arguably, short-term rentals are that's running a business, but there are some criteria that could prevent you from actually being subjected to this tax. So generally speaking, and again, we're not qualified to give advice. We're completely passive, but generally speaking, a stay of 7 days or less is going to be or is going to generate, let's say, active income that would be subject to UBIT. If a stay is 7 days or more, it's not something you, generally speaking, again, wouldn't have to worry about. If a stay is 30 days or less and there are services that are provided, like maybe a maid service or tours or meals like a chef, then that would also be subject to UBIT. So it is over the 7 days, but the difference here is services are being provided. So if you don't provide these services, the stay is 7 days or longer, generally speaking, you more than likely won't be subject to UBIT. Again, I really want to stress that you should talk to a CPA about this, because it's really not our role, but definitely part of understanding investing in short-term rentals. So it's very important that we at least bring it up as a topic that you should have in the back of your head. And when it comes to buying real estate with an IRA, you can get financing. It has to be a non-recourse loan, not a conventional mortgage. But so keep that in mind. And that applies for short-term rentals, long-term, really any real estate, as long as it can generate income. But the tax, if you get a non-recourse loan, is also UBIT. So again, unrelated business income tax. And the UBIT would apply to the UDFI, the unrelated debt financed income. So a lot of acronyms here, but basically the net profits attributable to the debt financing would be subject to UBIT. So trying to think of an example off the top of my head. So let's say the property is 50% financed and you made, let's say, $5,000 in net profits for the year. Since the leverage ratio there is 50%, 2,500 of the 5,000 would be subject to UBIT. So very, very simple example, because that's on net profits. You can take advantage of depreciation and other expenses when calculating that, with your CPA. But again, just some food for thought. If you do need financing, it's possible, but there certainly can be tax implications.
And one thing to note there, especially with with both UBIT and UDFI. UDFI I find isn't as scary because of the real estate tax advantages that can usually help offset some of that, at least some of that. But with UBIT, when it's just can't be avoided, if you have a property that's only stayed in 2 times every time, 2 days
Yeah.
every time somebody stays there, UBIT's probably going to, be involved. And so one thing that some of our clients will do, and we'll talk about checkbook control in a little bit here, but instead of having an LLC, you can file that LLC as a C corp. C corps are not subject to UBIT. So instead of paying the rate for UBIT, instead you'd be paying the corporate tax rate. And so you accept that you have to pay something, so you pay the lesser of two evils, essentially. But that's just another consideration, food for thought there.
Right. And UBIT follows the estate and trust tax schedule, if I'm not mistaken, and that it caps at 37%, whereas the corporate tax rate currently caps at 21%. So very popular strategy for clients that know they're going to be subject to this
Exactly.
UBIT tax.
Right. And so to get into some of the nitty gritty here, when you find the property, and even before you find the property, you set up the IRA, you find the property that you want to purchase with the account. What you're going to need to do right out of the gate from the beginning, the offer, the contract, the deed, everything needs to be titled correctly, either in the name of the IRA or in the name of the entity if you establish a checkbook control IRA, either a trust or an LLC. So that's really important. What we end up seeing a lot of times is people will come to us. They'll say, "Okay, I'm already under contract. I have X amount of days before closing. Can you help me get everything set up and funded quickly?" And while yes, sometimes we can, it's really important and creates less work for you and for the other parties involved if you come to us first before going under contract, to make sure that paperwork is not going to have to be rewritten or anything like that. It's not as simple as just an amendment to the existing contract. If you put your personal name on there, it would have to be a brand new contract that's put into place. So it's really important to navigate some of these things before you go under contract. Same thing with like earnest money. That has to come from the IRA out of the gate. It cannot come from you. If it did, we'd have to backtrack and correct things. And now you're creating more friction in the sales transaction that maybe the seller isn't really a fan of, or some of the agents involved.
Right.
And then on the flip side of it, just in general, once you have the property owned by the IRA, all income, all expenses will flow through the IRA or its respective trust or LLC. And so that's really important to keep in mind. If you have to pay a bill, if you have to, maybe there's a leak in the roof and you need to get something repaired or fixed, it has to be paid right out of the gate from the IRA. You couldn't pay it personally and then have your IRA reimburse you. You also just couldn't pay it personally to begin with and not get reimbursed. Is something that is it's a hard rule that the IRS has in place.
Exactly. So as Ian mentioned, there is an option to have a checkbook IRA, quote unquote. That's the supposed marketing term that we like to use, but I think it gets the idea across pretty well. So with a checkbook IRA, you have the ability to make and maintain your investments on your own without getting Madison Trust involved. So normally with a standard account, or we call it a custodial account, we're involved in everything. So we're involved in the purchase of the property. We're involved when expenses need to be paid, and all income that's generated goes back to the IRA directly. So that involves sending us paperwork, filling out forms, same idea for expenses, sending us invoices, some forms to complete. There's processing times involved and transaction fees. Depending on your situation, that might be okay. But if it's transaction heavy, like short-term rentals tend to be, the checkbook IRA is probably going to be your best bet in just terms of making everything very convenient for you and more than likely saving you time and money in the long run. So this is accomplished typically through an IRA LLC. That's the more popular option, at least in my experience. We have an IRA trust as well, and I can go over the differences shortly. But at the end of the day, whichever entity you choose is owned solely by your self-directed IRA. The account holder is the manager or the trustee, so they're in charge of everything. And a checking account will be established for the entity. We'll move IRA funds from the Madison IRA to this checking account, and then you would take over from there. So making that investment really is as simple as, first of all, making sure the LLC is listed as the purchaser and on title as well. But simply by cutting a check or sending a wire wherever you need to complete the purchase, whether it's to the title company or to the attorney's office. Really, it's as simple as that. Same idea for the expenses. Pay them right out of the checking account. No need to let Madison know. Just make sure you're doing everything by the book in terms of the IRS rules that we've been going over, and you'll be good to go. So this really provides you the most convenience possible in terms of managing your investments, and really comes in handy for real estate. When it comes to the trust versus LLC, of course, they're different entities. The LLC has that built-in liability protection, which a lot of real estate investors appreciate. But LLCs are a bit more involved when it comes to maintenance. So there's state reporting requirements typically, as well as state renewal fees. Nothing crazy. I mean, the most expensive state is California, $800 per year. But other states, some don't have a fee and some do have a minimal fee. But either way, it's a fee that's paid out of the LLC checking account. With the trust, there are no state reporting requirements or state renewal fees. So easier to maintain in that respect. At the same time, however, you don't have the same liability protection that you would benefit from if you have the IRA LLC. So again, another reason why real estate investors typically go with the LLC. But at the end of the day, they accomplish the same thing. You're able to buy property, pay expenses on your own, receive income via the checking account that's established. So yeah, that's the checkbook IRA in a nutshell. Not sure
Yeah.
if you have anything else to add, but
Yeah. I mean, for what it's worth, almost everybody that's investing in short-term rentals specifically should have a checkbook control self-directed IRA. The only instances where I would say it's not nearly essential is if you have a property management company that is handling literally everything and just sending a monthly net check back to the IRA. Exactly. If you're doing anything, like I remember way back when I was processing money for the company, I would see checks from Airbnb, or I would see ACHs from Airbnb rather. And a lot of times they don't put much information in there. So, you don't want these random, miscellaneous payments coming back into a general account that doesn't end up getting linked to your account, or at least not quickly, because there's not enough information. So if it's going back into your LLC or your trust's checking account, it's a lot easier to manage. It's a lot easier to see clearly what's happening in real time, and just manage it yourself. But again, if you have a property management company that's doing everything for you and you're just getting monthly or quarterly check back into the IRA, then checkbook control is not going to be all that advantageous to you, other than, say, liability protection.
Exactly. And this is somewhat unrelated to the slides that we just went over, but I do want to mention that when you're opening up an account with Airbnb or whatever platform you decide to use, don't use your personal account. Set up a new one for the IRA or for the LLC or trust. Keep everything separate, no commingling of personal and IRA funds or accounts in this case, just to make sure everything is compliant. So just one thing I wanted to mention, I don't think we have that mentioned anywhere in the slide, so I thought I'd just bring that up.
Definitely.
But anyway, going back to sort of the process here. So ideally, my bad, the account is opened and funded before you start, making offers or even start researching. If you know you're serious about purchasing real estate through your IRA, you might as well set it up and get it funded with at least enough for an earnest money deposit so that there's no delay. You're doing everything by the books and there's no issues to worry about going forward. So again, step one, just open up the account. It really is very simple to do online. It takes a few minutes. Even the same with the LLC. It's a quick application, and the trust usually takes about a week to set up either entity. It depends on the state for the LLC, but these are all general estimates. And funding is also very simple. Most clients that have an IRA elsewhere name any big brokerage firm. And getting the funds over to us really is a piece of cake. They fill out a transfer form. We send that info to the current custodian. Then they send the funds to us. So for the most part, the client really isn't getting too involved other than filling out the form. You can do a contribution too if you need. That's all you need for an earnest money deposit or a rollover from an old 401k, for example, or any other retirement account. And that brings us to step two. As I mentioned, at this point, after everything is set up, this is when you can start selecting properties, doing your research, and making sure that it aligns with what you're trying to do and your goals for the long term in your retirement account. I mean, this is what this is. And yes, step three, acquire the property. And we went over both scenarios, the checkbook IRA versus the custodial or standard account. Again, with the checkbook IRA, you're taking care of the purchase on your own. No need to get us involved. And when I say us, I mean Madison Trust. And with the standard account, we just need to see documentation. So send us the purchase contract, settlement statement, draft of the deed. These are some documents that come to mind. We do a quick review. You fill out a form to tell us where the funds should go. And at a high level, that would complete at least the purchase process. Yep.
And I get it if you a lot of people they don't want to fund the account before they find the property because they don't want their money just sitting around doing nothing for them for an extended period of time. What if you don't find a property in a short period of time? I get it. At the very least, because of what you need to do out of the IRA to make this all compliant, at the very least, you should be setting up the account and funding with enough to cover whatever you expect your earnest money deposit to be so that you can cover that. And then you have enough time to get to closing to bring additional funds into the account. That'll give you plenty of time. But it's really about the earnest money deposit that really trips people up a lot. Right. Either they're behind the eight ball at the very beginning because they didn't set up and fund the account, or whatever the case may be. But that's a big consideration here. That I just want to point out. And now to, I guess, brag on us a little bit as a company, Madison Trust. I've been here a very long time now, longer than most with Madison Trust. And so I've seen a lot of changes, but a couple of things that just have never changed on our side for the better is the level of customer service that you're going to get here versus other companies. I hear from people nearly on a daily basis that are currently with other providers. And so I hear a lot of horror stories, and you're not going to see that here. You're not going to experience that. When you have questions or you need help with something, you literally just pick up the phone and make a call, and somebody can usually answer your question right then and there in real time. We've got very well trained staff to provide that service to you in-house, in our office. In the instances where they can't answer it, it's usually because it's considered tax, legal, or investment advice. So, consider that you may need outside counsel, or you may need a CPA in your corner to assist you. But everything else, our team is here to assist with internally. And then also our fee structure has never changed in that we only will charge based on the number of investments that you have in your account, not based on the value of your account itself. I know other companies, maybe they'll have like a ladder system where if you're over a certain amount, then you're going to be charged this fee. If you're under this, you'll be charged a different fee. We're doing the same work regardless of how much is in your account. It does differ if you have more than one investment. So we're charging based on the number of investments that you have, because that's actually realistic to what the work we're doing is. So we're not just going to willy-nilly charge you more because your account is worth more. We don't think that's fair. We don't think that makes any sense, quite frankly. And so that's a big differentiator between us and some of our competitors as well. Like I mentioned, our team is very well trained. There's a lot of training that goes into this. That's one of the reasons why a lot of the big brokerage firms just don't want to deal with this to begin with. Is one, it takes designated, trained employees on this type of information, that they just don't have that sort of infrastructure in place already. But also it's a lot more manual. And so there is more manpower that goes into doing these types of transactions. It's not as simple as having an algorithm do everything for you, or, automating everything completely like you may see at some of the brokerage firms. We streamline it as much as we can. And so there is a really smooth process online. Ultimately, it's streamlined to you. It's automated a lot to you, but in the background, people are doing things on different departments within our organization, helping to make sure everything goes smoothly, make sure everything looks good. that everything's filled out correctly. And so you're getting that support every step of the way with Madison Trust Company.
Thanks for joining us, everyone. We really appreciate it. As Ian mentioned, we are here if you're ready to get started. So if you're not a client yet and have questions, reach out to either of us. If you're an existing client, we have our amazing team in place to help you out. That's all from me. I don't know if you have anything to
Yeah,
say.
no, this was fun. I hope it was
Yeah.
helpful for you guys. Yeah, have a good one.
Have a great day.